Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking energy. Let's talk crude oil. The recovery failed. We opened up with WTI a little bit higher today, actually up over 1%, but falling below 70 midday, down to 69.23, settling above 70, but the sell-off continues after the worst one-day move in over a year for crude oil. We actually had a point in time where the Brent WTI spread yesterday went negative. In other words, Brent fell below WTI. Now, I've talked about this time and time again. WTI will get pushed lower as that spread gets tighter and tighter. We ended up with the spread settling around $4.03 with Brent above WTI, which is the normal path. That's about a 10% increase from that settlement yesterday when it initially went negative and then settled back positive again. U.S.-China tensions is part of the reason we saw the sell-off in crude oil yesterday, and it continued a little bit today. U.S. and China hinted that trade talks were in the works, at least that they were on the minds of both the U.S. presidential administration, the Commerce Department, and some of the higher-up economic officials in China. Now, that sparked a demand bid in crude oil early, but again, that sort of waned. The trade talk release of tensions didn't really wane. But overall, crude oil fell on, again, increased supplies from places like Libya. Libya's force majeure ended, so that increased supply hit Brent pretty hard. And as Brent gets hit, again, weakness in WTI is nearly inevitable as it gets closer and closer and that spread gets tighter and tighter. Let's also talk about some easing in the Syncrude region of Canada, where there was a 350 barrel a day disruption. That is no official talk, but they're optimistic that that's only going to go for another week or so. So that, again, adding to the pressures there. And then refinery utilization showed a little bit of a lessening of demand. RU fell off to a more sustainable level below 97. We had levels of 97.1 last week and 97.5 the week before. That 97.5 number is the 36th highest refinery utilization number since they started keeping records in 1990. Now, that might not seem very dramatic, but considering there's 1,444 data points in that particular span, the 36th highest is pretty good. That's higher than 97.4% of all other RU numbers. So that showed strengthening demand, and the backing off from there was a good thing in terms of easing up on prices. So we saw a weaker crude oil price today here at the CME Group on the futures contract. This is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago.